Welcome to the deep dive. Today we're digging into the 2008 global financial crisis. It, it's an event that even now, looking back through the sources you sent, still feels massive. Definitely not just a small blip. I mean, this was the biggest worldwide economic crisis since the Great Depression.
Exactly.
So our goal today is to cut through all that information, all the noise in the sources, and really get a handle on the key factors, what actually happened and the effects that are still rippling outwards. Let's get into it.
It's a fascinating, if daunting topic, isn't it? What really jumps out from the sources is just how fast everything spread. It starts in the US, but boom, suddenly it's a global contagion. Really drives home how tangled up global finance had become. It sort of set the stage for this incredibly rapid, devastating chain reaction.
That interconnectedness, yeah, that seems absolutely key. But let's unpack the beginning. When we look at the sources, what were the sort of maybe less obvious fuses that lit this thing off? Beyond just saying housing bubble.
Well, the housing bubble is central, definitely. You had this boom in the early 2000s in the US, but the specific danger, I think, came from the type of lending. Banks were increasingly issuing these subprime mortgages, basically loans to people who, didn't have the best credit history. And crucially, many had adjustable rates, low to start, but designed to spike later, unsustainable for many borrowers. But that's only part of the story, really.
Right, because these risky loans didn't just stay on the bank's books, did they?
Yeah.
This is where it gets, complicated. How are they bundled up and sort of pushed out the door?
Exactly. That's the core of it. These individual mortgages, thousands of them, were packaged together into these complex things called mortgage-backed securities, MBS. Think of it like a financial fruitcake, maybe.
Okay, fruitcake made of mortgages.
Sort of. And then it gets even more complex with collateralized debt obligations, or CDOs, which were often bundles of slices of those MBS fruitcakes. But the critical point, and your sources hit this hard, is these complex bundles, even the riskiest ones, often got stamped with AAA ratings, top marks, falsely signaling they were super safe investments.
How did that happen? Lack of oversight?
A huge factor was, yes, a lack of really stringent regulation looking closely at this stuff. And then you had another layer, credit default swaps, or CDS. Companies like AIG were basically selling insurance on these MBS and CDOs, defaulting, the massive problem. They sold way more insurance than they had cash to actually pay out if things went sour, which of course they did.
So you have this incredibly complex, fragile structure built on shaky foundations.
Yeah.
When did the first cracks really start to show? The sources mentioned 2007.
Yeah, 2007 is when housing prices started to dip and those subprime mortgage defaults began ticking up. Then, March 2008, you see a big warning sign. The investment bank Bear Stearns essentially collapses and has to be rescued, sold off to JP Morgan with government help.
But that wasn't the main event, was it?
No, the earthquake moment, the one that sent pure panic through global markets, was September 2008. Lehman Brothers files for bankruptcy. It was the largest bankruptcy in U.S. history. Just days later, ARG, that giant insurance seller we mentioned, is teetering on the brink and needs a massive government bailout. Billions of dollars.
And the effect was immediate.
Instantaneous, almost. Credit markets just froze solid. Banks stopped lending to each other. Businesses couldn't get loans. Stock markets plummeted worldwide. And boom, we were tumbling into a severe global recession. It's quite something to look back on, the sheer speed of that collapse.
The global impact described in the sources is just staggering. Deep recessions hit the U.S., Europe, pretty much everywhere. And it wasn't just abstract numbers, right?
Right.
Millions lost jobs, homes, their life savings vanished. People who'd done nothing wrong. Global trade just seized up. Trust in the whole system evaporated.
Absolutely. And the response had to be huge. Governments poured trillions, literally trillions, into banks and key companies through bailouts. They launched massive stimulus packages to try and restart their economies. And out of that came a wave of new rules. In the U.S., you got the Dodd-Frank Act, aimed squarely at Wall Street reform. Banks globally faced new stress tests and had to hold more capital theoretically as a buffer against future shocks.
Okay, so major crisis, major response. But what about the longer term? What are the lasting scars or echoes from 2008 that, according to the sources, we're still dealing with today?
Well, there are quite a few. One thing the sources point to is how the bailouts, even if necessary at the time, created this perception, this anger about a two-tiered system. Wall Street gets saved, Main Street suffers. This seems to have fed into rising economic inequality, or at least the perception of it. And interestingly, it connects to the rise of more populist politics in various countries, a real distrust of established institutions, financial elites. And on the policy front, central banks kept interest rates extremely low for years and used tools like quantitative easing, basically pumping money